Greetings. Today is Wednesday, June 5th, 2024, and this is part 2 of our monthly market monologue, where I'm going to talk a little bit more about some of the economic data points, specifically some of the things that give us a little bit of concern, and we will circle back to what that means to you at the end of the video. But first, let's take a look at gold. So on the screen right now, we have the spot price of gold. In particular, this is a monthly candle chart. The red line is a 10-month moving average. The data goes back to 1990. And in particular, we're going to talk about this as well as a couple of other charts about why we are concerned that inflation might be ticking back higher. And gold is sometimes a foreshadowing what is expected to happen with inflation. So on the screen right now, you can see there's been a pretty strong trend. And again, this is a monthly candle chart. And so if we were look to the right-hand side of this chart, what's happened the last several months is definitely some upward movement. If we then change this chart to be inflation adjusted, now all I'm doing is I'm taking the price of gold and I'm dividing it by CPI, or the Consumer Price Index, to make this chart adjusted for inflation. And what you can see I've done is I've got this black line drawn. So what we are facing right now is a little bit of a resistance to the price of gold advancing when you look at this in an inflation adjusted manner. And it would not be surprising to see gold struggle a little bit, but typically, not always, but typically when we see a stock or a ETF or a bond, when we see something break through a resistance, especially a multi-decade resistance, that can tend to lead to a rather significant move. Now, again, I'm not predicting that that's going to happen, but I'm simply identifying the battle that is being drawn right now, and the battle that is waging right now. If this gold does continue to move higher, and if it moves through that resistance trend line, that is not a good sign for inflation and inflation expectations. On the screen, we have inflation. We can see that the most recent print is about 3.4%, certainly well off of the highs from a couple of years ago, but still elevated. And remember, inflation is measuring the year-over-year price change. But we haven't seen deflation. So those high grocery prices may not be continuing to increase at the rate that they were just a couple of years ago, but they haven't gone down. And that's really starting to catch up with people. That's the concern. And if gold advances through those levels that I'm talking about, that's foreshadowing or forecasting the fact that inflation might very well be ticking back higher. So again, remember, inflation, the target is 2%. That's what the Federal Reserve is targeting. They're trying to get inflation back down to 2%. Right now, we're at 3.4. The 10-year average has increased to 2.8. So we're still elevated. And again, if it's going to tick back higher, that is definitely a concern for the broader economy. Real quickly, this is wage growth. You can see very easily that that trend is down. Wages are not growing as fast as we would like to see them. So that is certainly a concern. Returning back to the inflation chart real quickly, let me just show one more reason why we are concerned that inflation might very well tick back higher. So now we have a look at commodities. Commodities are things like oil, soybeans, cattle, wheat, etc. So this is the United States Commodity Index. What has been happening, especially on the right-hand side, since 2020, we have this massive rally in commodities. And in 2022, there was a bit of what we call a basing formation. We've broken out of that. We've had another basing formation. It has rallied through that. So if we zero in on the right-hand side of the chart, this is what we're seeing. And so in the last several trading sessions, the overall basket of commodities that this index is measuring has indeed come down. But the concern is, and we're starting to see that again today in today's trading session, which is not reflected in this chart, that they're starting to come back. So while it has come down on the right-hand side, we're starting to bounce back up higher. So again, commodities are going to, especially oil, but all of those commodities are a key ingredient in the economy. And if the price of commodities is going to continue to rise, that's obviously going to impact inflation. That's the concern. It's not going to spend a ton of time right now on this because this data point is a little stale and we will not get another data point until early July. But this is consumer debt payments as a percentage of income. Obviously, the concern is if this continues to rise, and that's something that we are going to be watching in July when the latest data comes in. Now, in last week's video, I mentioned that the Atlanta Federal Reserve, their GDP Now tool was forecasting a 3.5% second quarter. And I mentioned that they were forecasting an update for May 31st, the day that I was shooting the video, but I just kept refreshing the buttons and nothing was updated. Well, about an hour after I was done the video, they did release their update, and it is no longer 3.5%. It is down to 2.7%. That's the update from last Friday, May 31st. However, there's been another update. It is now no longer 2.7. It is now down to 1.8. So when we have these forecasts, these GDP Now forecasts coming in, again, that's obviously a little bit of a concern. If the GDP comes in at 1.8%, that's what it would look like on the histogram. So still growth. 1.8 is certainly still positive, so that's still growth, but the concern is the change in the trend. We got some economic news out today. Payrolls are not growing at the rate that we expected them to grow. So again, these are just some concerns. I will again come back in just a second and talk about what that means to you. So stay tuned, I'm almost there. Last thing I want to touch on is the yield curve. This is the yield curve that we like to use the most, and this has been inverted for quite some time. We talk about this a lot. I'm not going to belabor the point because of the length of the video, but we're about 18 months into this yield curve's inversion. And what we want to highlight is the fact that historically, when these yield curves are inverted, when they uninvert, shortly after they uninvert, that's when the recession comes. So the current yield curve inversion is getting back to that zero line. And so the concern would naturally be, is the recession not too far in the distant future because this uninverts? Again, I've also gone on record multiple times that even though this yield curve inversion has a perfect track record, that doesn't mean it's always going to have a track record. So don't mishear me. I'm not saying a recession is definitively coming. All I'm saying is there are some concerns, and that's part of our job, is to look at those concerns, identify them, and pay attention. Because if you've been around long enough, if you've been watching our videos long enough, you know that I have been concerned, and I remain concerned that we are in a secular bear market. And if we are in a secular bear market, that means we will have periods of nice stock market gains followed by struggling stock markets. And so on the screen now is 65 through 79. If you have any questions about what you're looking at, by all means, send me an email, and I'm happy to explain this, or I'll point you to some of the other videos where we've talked a lot more about this. But this is one of the concerns. Now, what does this mean for you? And I'll land the plane here. If you are a client of ours, it doesn't mean anything. We are already taking care of this for you. And the reason why we trade and we execute trades the way that we do is because we don't need to forecast into the future in order for us to get the return that we're trying to get in order for to hit the goals that we're trying to accomplish for our clients. Because that's why we actively manage portfolios. I can't sit here and say that I'm 100% confident the market is going to move higher between now and the end of 2025. I can't say that. But I can say what's happening. If the trend is positive, we want to be involved in that. If a stock or a sector or a country is in a positive trend, we want to be involved in that. But if the data changes, we may not be interested anymore. And so that is the reason why we are actively managing money the way that we're managing money. Are we concerned? Yes, I am concerned. Does that mean that you should make any changes? I'm not suggesting that at all. Again, if you're a client of ours, we're already proactively taking care of that for you. And so far, there's nothing indicating that we need to do anything. Now, if you're not a client of ours and you want somebody that's helping you manage your portfolio in a far more active approach, by all means, feel free to reach out to us. We serve clients all across the country. And as we have highlighted before, our risk management approach, our active approach to managing money, is to manage risk. And we do that by trying to minimize drawdowns while still capturing upside momentum. Again, if you have any questions, feel free to reach out. We're happy to help. Hope this video helps. Feel free to share them. And again, comment as you see fit. And we'll talk to you again soon. Thanks.